Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. I certainly hope that everyone's having a fantastic week. I know as it relates to the markets and the portfolios that, definitely there's a deep sense of frustration, especially as the uncertainty spreads across the market. But what we want to do today is sort of alleviate some of that, because we know over the very short term that price movement can create anxiety. We know it. I see it in my own portfolio, and no one ever likes to see prices fluctuate wildly up and down, up and down. And so what we want to do today specifically is talk about some of this growth scare that's been hitting the market over the last 2 or 3 weeks. And we've seen it with energy stocks come down. We've seen it with the industrials and the financials. And now it's starting to spread to technology. And that's the area that's giving us the sense that what we're really seeing is a pause in some of the economically sensitive areas, refueling before the next move higher. And in technology, what we are potentially seeing is a reacceleration of that selling that initially took place in February and March. And that's why we got out of the way. And we're going to go over one chart in particular that kind of shows us why we're not, as investors, as portfolio managers, not that concerned about the Delta variant as it relates to its impact on the portfolio. And the reason why is we're going to look at the chart of Zoom. If the market was sniffing something out that was going to be widespread as it relates to shutdowns, we would see Zoom breaking out. And we're just not seeing that type of action in those stay-at-home stocks. But let's go ahead and get started. I'm going to go ahead and share my screen here. And let me just see if I can pull that up for everyone. So what we've named this week's presentation is Navigating Shifting Markets. And we know from the very beginning of this year that year 2 of the recovery was going to be tricky. The reopened stocks, the stay-at-home stocks, growth versus value, reflation versus deflation. We've seen this constant back and forth, back and forth. And as active managers, what we have to do is try to identify the winning camp when all is said and done. And sometimes that means absorbing a 2 to 3 month period of underperformance, which is what's happened. And we hate it. We can't stand it. But what we do know with a high degree of confidence that the companies we're invested in are so well positioned for the recovery that my own personal portfolio is highly levered to this recovery. And so, I've taken this opportunity, as we all get paid every single week, to add more dollars into some of these names as they've pulled back. But when we think of technology, this is the area that we're now pretty much close to 0% weight on. That unwind is beginning to reaccelerate. If we look at those ARK funds, down 13% over the last 5 or 6 days, that is very symptomatic of the second leg and the more dangerous leg of the bubble unwind that is taking place in technology. So we're going to go over that. We're going to review, what is the S&P 500 and how does it move? Because what we've seen is the S&P 500 is elevated, but the equal weight S&P 500 has actually been underperforming quite dramatically, and kind of a symptom as to why we've been underperforming. Second, technology stocks, as we mentioned, are beginning to break down. Only a matter of time before we think the very top of the technology leadership, that FANG cohort, is impacted by the unwind that's taking place right below its feet. And then lastly, oil's up. If we think of the macro call that we've had is, we bought energy stocks when it was oil was around $60. Oil's now at 72. The stocks haven't reacted. Why? What's going to unlock that value? Because many of these companies are making $10 more per barrel. In other words, a lot more revenue than they were 1 or 2 months ago. So what's going to unlock? What's the catalyst to unlock that value? That's kind of that's the agenda for this week. As a reminder from last week, reflation versus deflation. When we think of that economic recovery, when we think of unemployment claims hitting cycle lows this morning, when we think of ISM or the New York Empire Manufacturing Index hitting a record high, all of the high frequency economic data points suggest that this recovery is robust, it's for real, and it's much more V-shaped than the 2009 to 2010 recovery. So what does that tell us as portfolio managers and designers of portfolios, we're in the reflation camp. And if we're right about the reflation camp, that should push the 10-year interest rate higher as a reflection of higher GDP. What does that mean for stock allocations? That means we want to be levered to highly economically sensitive stocks. That is the oil, banks, metals, industrial, small caps, consumer discretionary. And those are the areas where we're focused on. Why have we underperformed? Because we're going through a growth scare right now as it relates to the Delta variant. Again, as we talked about at the beginning there, we're not that concerned about the Delta variant as it relates to the economy. The overall appetite in the US political arena for shutdowns is non-existent, but more importantly, the Delta variant is really not spreading that much amongst the vaccinated community. So I think that's an important point that we need to pay attention to. And then, of course, we're not in that deflationary camp. So that's sort of how the playbook that we continue to use. Now, in terms of the overall economy, the overall recovery, the common client questions that we're getting is the durability of this recovery given the Delta variant. What we do know in reality is that as the level of confidence in the recovery begins to reaccelerate, what we see is a direct correlation between where the 10-year interest rate is, this is the red line, and how the epicenter stocks behave relative to the NASDAQ or the technology stocks. So in other words, when the 10-year interest rate is going up, remember our playbook from before, it is a function of increasing confidence that the economy is getting better. And when the economy is getting better, the 10-year interest rate goes up. And notice what happens. The NASDAQ is sold and people buy the epicenter stocks. So that's the oil, the industrials, the banks, the consumer stocks, the stocks that are most impacted by a reopening or a shutdown of the economy. So what we see right now is that the first few signs are coming in that the market is starting to move past these concerns over the Delta variant, and people are starting to nibble back away. First, it was the industrials today, and now we're ideally start to see that spread to the oil, the banks, and the consumer stocks. And again, we saw is the 10-year interest rate, really kissed off that 200-day moving average, and we think again that's prime support for that to move higher and drag up those epicenter stocks. So when we think of clients ask us, okay, we understand your thesis, we agree with your thesis, but when do you expect to see results? We expect to see results here in the next 4 to 8 weeks in terms of when we look back 4 to 8 weeks from now, we'll be, according to our work, we can't guarantee anything, but we think we'll be substantially higher off these price levels. I personally use these pullbacks for my own portfolio, our family's portfolio, to add more money into a lot of these very attractively valued companies. Technology is the market, ladies and gentlemen. So when we think of the index and why we're underperforming the market, we don't own technology. And technology rallied in the month of June. But we're okay with that because technology is a prime risk. And we're going to go through why. But we can see here from 2008, technology went from being 19% of the S&P 500 to 37% of the S&P 500. Those are those pre-internet 2000 highs. When in 2000, at the peak of the tech bubble, technology was around 37%. So tech communications, 37%. Energy is about 3%, and that's where we're overweight. So we basically swapped our technology overweight with the energy overweight. So when people ask us, are we just a play on energy? Absolutely not. We're about 40% energy, but all we're doing is swapping that tech overweight with the energy overweight. A very key and important point here. So tech, this is the chart of the hour, the chart of the day, the chart of the week, and the chart of the year. What we see here is these are the price to sales valuations of the technology sector. We have now surpassed the 2000 bubble highs. This is a dangerous, dangerous situation. Yes, they've continued to rise. And as a result, we have underperformed because remember, we go back, that's 40% of the stock market, 40% of the S&P 500, pardon me. So when the S&P 500 goes up because 40% of it's in technology, we're going to underperform because we're close to 0% in technology. But we're okay with that because this is what's going on. This is what's sucking the dollars out of every other part of the market. We don't want to be here because this is what we call beheading risk. These stocks can go down 50, 60, 70% and still be reasonably valued after that. So again, in fact, a little bit expensive. So we want to be really, really careful. And that explains why we made that rotation in the overall portfolio. And we see that. Remember, these ARK funds, very emblematic of expensive technology stocks. Initial sell-off, and then we had the bounce. And this is where we unloaded technology. And then we kind of muddled around, sold off again. And then we had this, pardon me, we had this strong counter trend rally. We did not participate in this. And that was a function of the recent underperformance in the investment strategy. But notice what's happened here over the last week. This has started to really accelerate the sell-off again. This is a dangerous situation as it relates to these high multiple technology stocks. Within energy, what we see is despite the recent pullback in energy stocks, we've seen no deterioration in energy credit. In other words, the implied credit risk on energy balance sheets, oil and gas balance sheets, what we can see here after a huge improvement here on the right, we're continuing to move down to cheaper levels. And notice what's happening in the oil service space. Now, these are just two sample stocks, Schlumberger and Baker Hughes. And what we can see is, despite the fact that they're making less revenues in the prior cycle, their margins are higher on lower revenues. And this is very emblematic of what's taking place in the energy sector. Over the last 10 years, the energy sector has gone through a bear market. They've cut costs to the bone. And so as revenues just begin to rise a little bit, it is an ATM machine for these companies. Every single dollar of sales that they're generating is immediately falling to that bottom line. And so as confidence returns to the market as it relates to growth, as it relates to the OPEC deal, right? There was some uncertainties about OPEC, Delta variant, the 10-year interest rate moving up. This is going to dramatically reprice higher. And that's what we're positioned for. Again, I don't know if it's going to be in a week or 2 weeks, but I'm very confident over the next few months, we're going to have some dramatic returns as it relates if the situation plays out. And by the way, that is why one of these stocks is the largest weight in the portfolio. So in terms of the oil, in terms of the energy investments, a real sample case here is we always ask ourselves this basic question. The companies we own, are they making more or less money than they did a month ago? And are the stocks higher or lower? As we know, the stocks are lower. But we think of a month ago, oil was at $60 a barrel. Now it's just over $70 a barrel. So for a company that's generating $100,000 a barrel or producing 100,000 barrels a day, they're making $540 million a month ago. Now they're making $630 million. So in other words, they're making $90 million more in just the last month. And that's where a lot of our companies are right now. They're making more money. And so at some point, the market dramatically will reprice to the upside to give credit to where credit is due. And we can see that here is that as oil reprices higher, the historical dramatic repricing of these stocks we see here on this overall curve, whether it relates to Schlumberger or Baker Hughes in the past. Again, revenues are exponential to the price of oil. And we'll see that come out here over the next few weeks. Now, the question is, will the oil price continue to go up? Because if it goes down to $50, well, then my argument is completely moot, correct? And so what we looked at here is oil inventories in the US continue to drop, right? This is, again, another very important point. So every single week, we continue to see deep draws on inventories. The other thing that we're seeing is that the futures curve, so when we look at oil prices out into the future, what we see is the entire curve is shifting upward. And that's important because a lot of times when we think of energy companies, they're not just producing now, obviously they're producing in the future. And some people have been concerned about the backwardation in that curve and the fact that oil prices on the futures market is lower a year from now than it is today. But that's all been shifting upward. And as future prices shift upward on the curve, guess what happens? The impact in terms of a discounted cash flow basis on the valuation of those stocks dramatically moves to the upside. So again, another reason to be very bullish on oil and the underlying stocks. And we see that here with US oil consumption. America is accelerating upward and to the right, and we don't see that stopping anytime soon. Lastly, the banks, another big weight in the portfolio. The banks had a dramatic move up, and we've had a little bit of a pullback. That's okay. That's healthy. So what we see here is as the recovery continues, that's going to equal higher growth. Higher growth equals higher interest rates. Higher interest rates are good for the banks. Skate to where the puck is going. Don't try to chase return, especially in technology. Skate to where the puck is going. And this is where we think the returns are going to be 2, 3, 4 months from now. So overall, we're deeply empathetic. We know that the last 2 months have been frustrating, but despite the uncertainty in the non-FANG areas of the market, so the non-Facebook, Amazon, Netflix, Google, et cetera, areas of the market, the most attractive areas remain non-technology. Would you believe that the Apple, Facebook, Netflix, Google, Microsoft, Amazon, those 7 stocks, Tesla, make up 27% of the S&P 500. That is one of the deepest risks that we see right now. So overall, nominal growth is coming in higher than expected. The consumer is flooded with cash and is desperate to spend it. And overall, higher growth is driving higher utilization rates, and that is good for energy and commodities. Thank you so much for all of your patience, your loyalty, and do know that every single day we're reviewing the portfolios, and if our thesis were to change or be challenged and prove to be incorrect, we will change. But right now, we see a lot of value accruing in these areas of the market, and we want to stay focused. We don't want to try and chase short-term returns, and that's how effective investing works. We had a moment like this 2 or 3 years ago with technology, and we stayed true to that process. And this will play out as well. And so we're very confident that if anyone has any questions, please feel free to reach out to your advisor or here at the office at 888-543-3776. Thank you again. Have an absolutely fantastic weekend.